focus away from slowing growth. Rob maintaining a buy rating on the stock with a $200 price target, and he joins us now. Rob, why is it that the market took Amazon's word for it and didn't take Google's word for it when they talked about the promise of AI?
I think, above just the Gen AI commentary, don't overlook the fact that they had...
What the trends are leading into Apple's earnings next week.
Yeah, consumers mixed. It's still pressured. Amazon results were solid on top line. Their guidance was a little bit light. There's a big margin recovery story that's happening beneath the surface on retail, and there's an awful lot of earnings power in the retail business. They doubled their plant capacity coming out of COVID, and the unit economics in their retail business are really upside down right now. I think that's being masked. And the earnings power is yet to show through. They're losing quite a bit of money for every package delivered, and there's a long road ahead to restoring margins in the retail business. So in terms of consumer spending, it's still pretty squishy, and the Amazon results and outlook would sort of support a pretty tepid consumer.
How much is geopolitics going to really reign supreme in Apple's earnings calls, given what we've seen with China production and the potential competitive landscape?
Yeah, it's a risk. How much that shows up in over what time frame, I think, remains to be seen. But it's definitely something that investors have to take very seriously when they're evaluating what might happen next on the geopolitical front.
Rob Sanderson, thank you so much for being with us on a day where we do see a bit of a lift, a little bit of a buy the dip kind of moment following a correction that really entered that 10% territory yesterday after the earnings had already come out. A big question about why some companies are seeing a gain from some of the commentary and others not so much. Coming up, the market moving events that you need to be watching. That's next in our trading diary. Today you can see that reprieve continue as the session grows older, about 23 minutes into the session, and still the Nasdaq leading in a bit of a rebound. Bloomberg's The Open. I'm Lisa Abramowitz in for Jonathan Farrell. Let's take a look at the markets. You can see it fading as the session grows older. The Nasdaq still, though, holding on to those gains, up 0.9%. Outside of stocks, you can see in bonds, yields actually clawing back some of the gain that they had previously seen. Again, there's something going on in markets. Time now for the trading diary. You need to be watching next week. Tuesday, U.S. consumer confidence along with the BOJ rate decision. Wednesday, an FOMC rate decision followed by a Chair Powell news conference. We'll also get ISM manufacturing and job openings data, as well as a refinancing agreement from the Treasury Department. And Thursday, central bank decisions continue with the Bank of England, and then we round out the week with the October payrolls report on Friday. Today, it feels like a reset day after a tumultuous week. We've really tried to go up and down. The volatility is sort of benumbing traders to try to set and wait to understand the new paradigm. Maybe next week, when we get all of these central bank decisions, we'll get a better clue. This was Countdown to the Open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Friday, October 17th. Here are the top market stories that we're following for you at this hour. You got sticky spending. The U.S. keeping spending and underlying inflation speeds up, hitting a 4-month high. You're looking at stocks a little bit mixed, as well as the bond market. And a mixed bag for big oil. Chevron and Exxon missed earnings estimates. Earnings are still a little overshadowed by two major mega deals. Chevron, though, getting hit quite hard. We're going to speak with Exxon's CEO, Darren Woods. And earnings, shake it off or it ain't going to be all right. It's been a big week for earnings, a big week for Taylor Swift. Tech takes the hit. We're going to get the takeaways over the last 5 days here. From New York, I'm Alex Steele with my co-host, Guy Johnson. Welcome to Bloomberg Markets. This is the last day that we will be here together in this proximity. We will miss you. But I find this last 5 days really interesting, and I'm not 100% sure I know what my takeaway is yet.
Certainly my take out of the European earnings story is they stink.
Yes, but they're supposed to be factored into the price.
I know, but they really stink. The consumer story, the data out of the States continues to be the kind of the big exception. You look at the numbers we've had this week, they continue to be very strong. Today's data kind of fits that narrative. Yeah. The consumer continues to spend. That's the line between that data and Taylor Swift. The Taylor Swift, Beyonce, Barbie story this summer has been phenomenal, and it continues to a certain degree. I wonder whether we're running out of steam on that, but spending continues to be a big factor. There's a great story, a fantastic story on the terminal, which I think really speaks to some of this narrative as well. Buy boomers, sell millennials. That's according to Bank of America, i.e. the boomers have got loads of money. They don't have mortgages. They're not being hit by high debt, and they're spending. The millennials, on the other hand, not so much.
And they have money in money market funds, and it's not throwing off a lot of cash. To your point on earnings season, though, the numbers might have been okay here in the U.S., but the outlook is still really confusing. Yep. And clearly, tech has been hurt quite hard in the last couple of days. Yes, Amazon was okay-ish, right? The stock is up, but really we're nowhere in the last week in terms of the stock price.
But I think you've got to take a step back and look at tech and look at that story and say expectations were so high. We're disinflating a little bit of the AI story. The numbers are still exceptional. Any other sector, and you got these kinds of numbers, it would be phenomenal, but they're valued to such a degree that maybe they need a little bit of a reality check. Yeah. Elsewhere, it's just kind of horrible.
It's mixed.
The earnings, the only area that isn't, and you talked about the energy stocks today, is energy.
Right. Well, I mean, but even Chevron got really hit. I mean, we're looking at the biggest loss biggest weekly loss. I think it's down like 6 days since 2021. But then again, is that just idiosyncratic, or are we pricing out something else, considering the oil prices are over 90 or?
Buy boomers, sell millennials. Somebody called Alex a boomer earlier on the week. Was it last week?
Really hurtful. I really haven't let that go.
Didn't go well. Yeah. Didn't go well. Our question of the day is a fairly straightforward one. At the end of the week, how ugly are earnings? What does the earnings picture really look like right now? Denitsa Zikova and Abigail Doolittle joining us on set to try and figure this one out. Denitsa, here in America, it looks less ugly. Globally, you pull it all together, it looks really ugly, and Europe looks particularly ugly. What is your take? We come to the end of the week. What's the early read on the earnings picture?
I think the biggest takeaway from this week, and it's kind of a worrisome one, is that the disappointment over poor earnings is outpacing the excitement about better ones. And I think Wednesday was a great day to see that, with Alphabet having its second worst earnings day. And obviously we had some good news from Microsoft, but this just wasn't enough. And we actually had the worst day for the NASDAQ this year. So this kind of trend, you can see it in breadth, you can see that a really large part of the index is under pressure right now. So obviously everyone is looking up to those big names. Everyone, is looking at what's happening to the cloud, what that is going to mean for AI hype. So every single of those names weighs on sentiment. And just to give you one number, on Wednesday and Thursday, we actually saw 800 billions being wiped out of the NASDAQ just for 2 days. Yeah. Obviously today we're seeing a little bit of relief. But overall there has been some negative reactions to those earnings this week for sure.
Yeah. And I told you, we glossed over this. This is the final read for UMich 1-year inflation expectations, Guy, but for October, but it went up to 4.2%. Like it's been a little sticky with the street handle.
Inflation feels like it's reaccelerating.
Yep.
But I do wonder how sustainable that is. The consumer is being pushed really hard at the moment.
Yep.
Another great story on the terminal talking about the fact, are Americans living beyond their means at this stage? And I think it goes back to the boomer story as well, but is this sustainable? Is Q3 going to be repeatable in Q4? Taylor Swift isn't going to be here.
Yeah, she's going to be where you guys are. So does that kind of change the game? We just, but not really. So Abigail, that kind of brings me to you. So how ugly are earnings? And I wanted to kind of get you in the conversation in terms of, say, what the technicals are telling you about that story.
Well, I don't think that the earnings actually from the numbers, which is where I'd like to start actually, and then bring it into the technicals, I don't think it's as ugly as the stock reaction would suggest, because we have the S&P 500 down more than 5% since JP Morgan. We have the NASDAQ down more than 7%, and yet you have, with almost half of the S&P 500 companies having reported already, we have nearly 1% beating on sales. We have 7% beating on earnings. We're looking at 2% sales growth. We're looking at roughly 8% earnings growth, so that's not so bad, but that's in a vacuum. When you put it into the picture of stocks being up so much on the year, let's not forget the NASDAQ 100 earlier this year, its first best half ever, up more than 40%. The FANG stocks up more than 50%. So really priced to perfection. Investors didn't quite get it. Plus, you have a tightening Fed, inflation back on the rise, geopolitical tensions, so there's no real wiggle room. So investors taking profits, I think, for some of these companies that have put up big results. And it's really interesting. Tech, these are the best reports actually in terms.
Yeah.
They're great.
They're anybody else.
Yeah, and yet they're getting hit. They're up so much. They're up 100%. So investors taking some off the table.
Okay, so you bring up the point about expectations, and this then goes to the guidance story, Denitsa. The numbers are okay. The bar's been lowered. There's been plenty of bar lowering going on coming into this quarter. But then I read through the transcripts, and you go through one company after another company, and the outlook statements are getting progressively worse. Equity markets are meant to be a discounting mechanism. They're meant to look forward. That's what you should be looking at, and that's where the pain seems to be showing up.
Yeah, for sure. That's definitely forward sentiment is being weighing on that. But it's important to say that the price per perfection is definitely playing the biggest part.
Yep.
We've seen like the Nasdaq having around 30% premium over the average S&P stock. So obviously every little small thing, whether it's forward guidance in this case, whether it's outlook for cloud, all those small things are really weighing on sentiment going forward. And of course, we have to talk about bond yields. Competition has been rising in terms of capital. We saw another push for bond yields. We saw the auction numbers. It doesn't look great.
We saw better.
But you've got to compete with 5% now.
Yeah.
That's the benchmark, and that's a big benchmark to kind of battle with.
Yeah, but on the other hand, you had Bank of America, Michael Harnett, coming out and saying, hey, there could be a 5% drop for the S&P based on some technical
5%.
levels. And we were joking earlier, we're like, that doesn't sound so bad.
I will relative to, and to go back to your question on the technicals, so the technicals are not great around this earnings season, and a week or 2 weeks ago we were talking about is it the micro or the macro. I would suggest the micro is factoring in a bigger way than we might have expected relative to these earnings, because we now have the S&P 500 doing what the Russell 2000 has done, below its 200-day moving average. The Russell 2000 is quietly almost in a bear market. I mean, that's really kind of amazing that we haven't been watching that a little bit more, but the S&P 500 and the NASDAQ appear to be following, and a lot of it happening on this earnings season. Again, we're looking at the NASDAQ 100. I don't know if today it's no longer in the correction, but I'm guessing that we'll probably work back into it next week. Apple, we're looking at negative sales growth. We're looking at deceleration. I mean, I guess in some ways the bar is set low for them, but the reaction here has not been good. And all of this is before the Fed. I want to emphasize the fact this is not just the micro alone, but when you put this in a liquidity tightening scenario, geopolitical, inflation, China slowing, that's another thing to think about. The world's second largest economy is slowing. We don't know how bad it is. And a recession. A lot of people are talking about a shallow recession in the fourth quarter.
Final point, my last day in New York, going back to Europe. Denise, Europe looks as if it's ahead of the US. The number
into the downside, you mean?
Into the downside.
Okay.
You've got Air France today, Electrolux. I'm just going through the list. Sanofi, NatWest. The list just goes on and on and on in terms of the stocks that are getting hit.
Mm-hmm.
There are some really bad numbers coming out of Europe. Yeah. Is Europe different, or is it just first in terms of kind of seeing this downdraft?
Yeah, I mean, that's the big question. But I think even going back to the whole, is there a recession? Is there going to be one? When it comes to Europe and U.S., there has been a big divergence for a very long time. And obviously, everyone has been saying that the U.S. is in much better shape. And you can argue the same with earnings, that this divergence is happening again. And if you actually look at flows this week, there is a preference for U.S. stocks despite some of the outflows, but people have been buying some tech stocks. So perhaps whether there will be a recession in the U.S., I really don't want to take a side on that, but obviously things are looking a lot gloomier in Europe, and we can see that reflected in earnings. We can see that divergence.
Really good conversation, guys. Really appreciate it. Happy Friday. Bloomberg's Denitsa Takova and Abigail Jodla. Thank you so much. So coming up, we're going to continue all of this conversation. The question of the day, just how ugly are earnings? Just look at Apple, too, below its 200-day moving average. Lisa Erickson of U.S. Bank Wealth Management is with us. This is Bloomberg.
We look ahead to next week.
Next week when the FOMC meets.
What to expect from the Fed next week.
Next week's policy meeting.
We'll have a more hawkish hold from the Fed next week.
Beating that drum of higher for longer.
Maintain a very hawkish narrative.
They are also not talking about rate cuts, and we are not expecting rate cuts to come.
It's this give and take that the Fed has to manage.
The continued strength of the economy actually handcuffs the Fed.
The economy has much more resiliency.
The resilience of businesses, the resilience of the consumer.
The labor market that is just, very strong.
A pretty strong labor market.
The Fed is looking at all of these data juxtaposed with inflation that's still too high.
The Fed is not looking to tip the market into a recession.
Everybody's wondering what these lagged effects of rate hikes are going to be.
Those were some of, there we go, Bloomberg TV guest speaking earlier on what's going to be big in markets next week. And clearly it's going to be the Fed. But before we get there, we still have to work our way through a lot of earnings. And that brings us to the question of the day. Just how ugly are earnings? What did we learn this week? Sure, stocks might find some stabilization today, but some of these numbers and outlooks were really rough, and the outlooks being very, very uncertain. Joining us now, Lisa Erickson, U.S. Bank Wealth Management Senior Vice President and Head of the Public Markets Group. All right, Lisa, your read. How ugly are earnings?
Well, when we look at the report so far, and granted we're only less than halfway through earnings season, we're actually seeing fundamentals indicate that things are okay. So coming into the quarter, the expectations really were for a flat quarter, that earnings growth would only be up about 10 basis points. And while that was an improvement from prior quarters where they were actually down, it wasn't, super great. However, the actual numbers through midweek this week are actually about 14.3% on that earnings growth number. And it isn't just one or a couple of key stocks or sectors leading that, but really we're seeing some good percentage beats across the board. And so overall, when we look at it, the story to us really has been this earnings season that fundamentals continue to be resilient from the corporate sector. But again, to the earlier discussion you just had on the program, what's going on differently is sentiment, that people are just very cautious in how they're interpreting those results.
Yeah. And that's the point, Lisa, isn't it? The approach at the moment seems to be glass half empty, and if you miss, you get punished. And that makes it a difficult environment to navigate. How do you navigate that when you are getting some massive swings? And Alphabet's a case in point. Some really big swings with some really big stocks. If you are trying to invest, you're not trying to trade here, you're trying to invest. Can you invest given the volatility we're now starting to see at a single stock level?
We're actually recommending to our clients that on the back of these conflicting forces that they actually stay neutral in U.S. equities right now, which would mean that whatever is their long-term strategic weight to the asset classes, they just stay at that, as opposed to really trying to overweight and bet on a positive rebound or underweight and be overly bearish. And really the reason why is, again, as we've been talking about, what we've seen in the corporate results and in the consumer as well, is that there has been really a fairly solid showing. Both sectors have been able to maintain some good momentum despite, many headwinds. However, on the other side, we do still have very tight policy, and inflation has not come all the way back down to its 2% targeted level. So we've really got a balance of reward and risk.
So, Guy, this goes to your point, too, on, say, European earnings, which have gotten, we knew they were going to be bad, and then they're just really bad. And this brings me to Ford, for example. So Ford's down 9%. We haven't seen this kind of slide since 2021 on stuff that we already knew. Like, they already settled with the UAW. The cost is going to be $1.3 billion. They suspended guidance. Obviously, so did GM. And I'm just wondering why the market was so wrong-footed and why the selling pressure is so extreme.
There's also, I just wonder whether we're getting to the point as well, whether or not you're kind of, you talk about it being better to travel than arrive once the kind of the news is priced in. I just wonder whether that tone is changing, that the market's now going, yeah, okay, we've got the news now, we can take a step back and take a more realistic assessment of what is happening here. And rather than being always optimistic, equities are by nature normally optimistic. You've priced in the bad news, you can therefore talk about good news. But I just wonder whether we've got to the point now where you've got bad news and it's bad news.
Yeah.
And I wonder whether that is a shift in tone, whether equity markets and equity market investors are just becoming, by nature, less optimistic.
Okay, this feels like this would be a massive sea change, Lisa, if bond investors and equity investors both become now naturally negative and pessimistic. Do you agree with that? Or do you need, how do you then look through the weakness that we're seeing in terms of outlooks?
Well, certainly to your point, Alex, we've had really a tale of two halves when we look at year to date. Earlier, obviously, in the year, investors were the opposite, where they were really looking through anything and really continuing to push those stocks up. But again, we've had this sea change in sentiment, and you can see it in technical trends where if you look across major sub-asset classes within the equity market, you are seeing most in a downtrend with the exception of U.S. large cap equities. And so, again, when we just look at that trading picture and the fundamentals, we really believe that best positioning right now is at that neutral stance while we continue to monitor both the data and
Lisa,
the sentiment.
is neutral 60-40? Is that what I'm doing right now?
Well, what it would be is whatever is a client's appropriate long-term allocation. So 60-40 if they're more mid in terms of risk, but whatever would be their normal allocation given their circumstances.
Can we broaden it out a little bit too? Can we do the Europe-U.S. question? Guy brought it up earlier in terms of earnings weren't going to be great and then they're really, really bad and the stocks are getting hit really, really hard. I mean, talk about glass half empty in Europe. It feels like there's not even a glass. At what point does the valuation become attractive to you, Lisa?
Well, certainly right now between U.S. and EFA, we're again recommending more of a whatever would be your normal stance. And to your point, while there's been some more difficult fundamentals on the European side, they also have been really showing more attractive valuations. So right now, again, we just think while the data continues to play out, to continue to stay at more of that balanced stance.
Lisa, great to see you. Thank you very much indeed. Lisa Erickson, US Bank Wealth Management, Senior Vice President and Head of Public Markets. Talking of glasses, look at what's happening with LVMH. Look at what's happening with Remy Cointreau. You talk about glass half empty. That is where that's where the story is right now. The Aperol Spritz has gone flat. LVMH has been talking about it for a while. You got Pernod Ricard saying the same thing. The drink story, I think, is a real microcosm of what is happening here. America isn't drinking high-end spirits right now.
But I thought that we knew this. Like I thought
we knew this as well. LVMH had told us this a while ago.
This is my point. Like we knew this, so I don't understand.
I think it's the scale of the downgrade. It's the scale of the downgrading of expectations from companies like Remy. We knew it was tough, but actually it's worse than tough. It's come down really hard.
Well, I think that maybe this is also the Alex Tanner indicator, right?
You don't drink?
I rarely drink anymore, so therefore thus we know that long Prosecco stocks is not the way to go.
Absolutely, and that does seem to be working out as a pretty accurate, accurate trade right now. But yeah, no, talking about the glass being half empty, the European drink stocks, I think, just encapsulate that beautifully. We're going to turn to tech next. We need to figure out what's happening there. Prime earnings results for Amazon, get it? The tech giant posting robust sales and profit growth. Details next. The startup is coming. This is Bloomberg.
It is 22 past 7 on the West Coast. Oh, that looks beautiful. We're going to get to the startup where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now, Bloomberg Technology co-host Ed Ludlow. Ed, I'm looking at Amazon. Stock is up 8%. Right. But if you look at where it's been, it got hit so hard. We're like barely above the level that we were before the last 2 days sell-off. Walk us through the numbers. The numbers support 7%, 8%, or should it be more?
Well, I think the market's just buying the story that Amazon's trying to tell around cloud, AWS. You know, it was the only metric that missed top-line expectations. But if you dig deeper, it's kind of rosier than, say, Google Cloud earlier this week. And, you know, it was the first time in a long time where we got quarter-on-quarter growth in AWS. But on the bottom line, it's just astonishing. You know, Andy Jassy is just focused on efficiency and cost cutting. And AWS, Amazon's cloud unit, has accounted for the majority of the company's operating profit for quite a long time now. And operating income this quarter came in almost $1.5 billion ahead or more than the street was expecting. So not only is it the cash cow, it's more of a cash cow than we expected. And the story that Andy Jassy told was, yeah, guys, this generative AI stuff is great. We're signing new customers, and in the future, we're going to grow. It's great.
Okay, Microsoft, Alphabet, Amazon. Put it all together. Right. What's the message?
Well, here's the thing. I asked Ruth Porat, who is the CFO, President, and CIO of Alphabet, parent of Google, did you add new customers in the quarter, specifically in the field of generative AI? And she didn't answer the question. She did talk about a backlog of demand across all AI products, but that they didn't sell the same story to the market. The market couldn't see in their financials all the hype around generative AI. Are there actually customers coming to you and saying, we need your cloud compute? Microsoft had it in their numbers, right, for Azure cloud growth overall, but they make money selling software as well. So those are the principal differences.
Ed, let's move also to some headlines that you just reported recently, and that has to do with X, the revenue split, and what's happened to subs. Walk us through what you reported.
Yeah, so last night, Elon Musk and Linda Yaccarino hosted their first ever joint all-hands meeting. And what they told staff was that they want to go into video and hiring, but specifically they name-checked and called out YouTube and LinkedIn and said, that's our competition. That is who we are going after. My understanding from a source is that right now, revenue split is 75% ads, 25% subscriptions and data. But remember, revenue is probably down like significantly year on year. Today is October 27th. It marks 1 year since Elon Musk closed the deal to buy the company formerly known as Twitter. They've had advertiser flight. There's evidence it's coming back. Remember that, you know, subscriptions from a user-based perspective is tiny. It's probably like 1% according to third-party data. I've actually got some data from Insider Intelligence that just hit my inbox. They reckon that for full year 23, revenue will be down almost 55%, $1.8 billion. A year ago, it was like $4.2 billion. So that shows you how they're looking.
Oh. Have you subscribed to X? Well, what am I doing? Why am I asking him this? Never mind, Ed.
I was on Twitter.
Right, Ed, thanks a lot. Really appreciate it. Bloomberg's Ed Ludlow. You can catch Ed and Caroline Hyde on Bloomberg Technology. That's coming up in about 90 minutes' time. Intel CEO will be joining them, so stay with them for that. Pat Gelsinger there. We now welcome our TV and radio listeners to take a look at ExxonMobil. The stock is down about 0.2% on earnings. Now, it missed earnings estimates in the third quarter. It did boost its dividend and a huge increase in cash flow. So we want to get more details here with Darren Woods, ExxonMobil chairman and CEO. Darren, we really appreciate you joining us on this very busy earnings day. I just want to start a little nerdy, and that's with the chemical side of the business. That's really what led to some of the weakness in earnings. Chemicals is a really wonderful indicator as to the global economy. What should be our takeaway from that weakness for you guys?
Well, I think there's two things to look at in our chemical business. One, obviously, is demand and the link to GDP, but the other is the supply. And we typically see that commodity cycles in chemical are driven by generally growing demand, but then peaks of supply coming on. And that's certainly been the case that post the pandemic, a lot of supply has come on. We haven't seen excessive growth in GDP, and so you're seeing that pressure manifest itself in very low margins. Mm-hmm. But that's a supply issue. Demand hasn't been as strong as in the past. past, but we're still continuing to see rising demand, just at a much slower rate than historical. My expectation as GDP begins to pick up and China continues to kind of come out of its post-lockdown issues, that we'll see growth in chemicals pick up, but we're still going to have to work through the supply overhang.
Okay, so that's more of a supply issue than a demand issue. That's good to know. To that point, if we just go to the broader oil story, because in some ways, let's get through earnings, but really the story for you guys is the Pioneer deal and the takeover there. And some of the numbers that you guys were tossing out here are huge, like increasing a provable reserve to 1 billion in the Permian. Some analysts are worried that you can't get that far. What are you guys going to do that gets you there?
Well, what we're going to do is what we're already demonstrated we're capable of doing. So if you go back in time, Alex, we set out a strategy to make sure that we were applying the full weight and force and capabilities of our company into the unconventional space. And that's been a concerted effort to develop technologies to improve recovery. We've been implementing that in the acreage that we've got today in both the Delaware and the Midland. We're seeing very good results. We've demonstrated the ability of those technologies, the techniques, and the development processes that we have in place. And what we're doing now is taking that proven capability and applying it to the best acreage in the Midland. And so Pioneer is basically in the fairway of acreage in the Midland. And so we've got this very good acreage that we're now going to apply the capabilities that we have in Exxon. So that's the combination. They are demonstrated capabilities that we have built into those synergy numbers. It doesn't comprehend the additional technology that we're working on today that's in the pipeline that, frankly, we think has promise. So our view is, while the numbers are big and it reflects the capabilities that we bring from ExxonMobil and marry up with the acreage and the capabilities that Pioneer has, we've got additional upside coming down the pike.
Wow.
Darren, good morning. It's Guy. You are, to your point, and you're just talking about what is happening here, but I think it goes and speaks to beyond that and what else you're doing. You are proving to be very good at execution, project execution. You're demonstrating that. You've got a new refinery coming on. You are proving to be very good at that. Others in the energy space are not, particularly within the renewable space, where it is proving to be very difficult to execute well right now. Can you just talk to me about how big an advantage that execution story is and how you can leverage that to do more?
No, I think you've hit on a really important point, Guy, and you're absolutely right. It is critical, particularly in a capital-intensive industry like ours, to be very good at executing large, complicated projects. In 2019, we consolidated all of our resources on projects into one global organization. That organization has the sole focus of making sure that we are developing world-class, industry-leading projects and then executing them ahead of schedule and ahead of budget. And we're demonstrating that. That applies itself to our low-carbon solutions business today. And so if you look at the challenges of going from carbon capture or biofuels at scale or hydrogen at scale, marrying that with requirements of storing and sequestering CO2, we are in the sweet spot of pulling all those things together and doing it at scale, which is going to be required to address the challenges out there with respect to the size of the emissions that we have to reduce. There aren't any other players out there that have that same capability.
And that gives you a huge advantage. Now, you've just done the Pioneer deal. Alex was talking about that. Does that execution ability, though, now give you the opportunity to look at what's happening in the renewables space where there is a tough time emerging and start to cherry pick assets there as well and use your ability to execute to turn those assets around?
I would tell you we're going to leverage not just our project capability, but our technology capability. And the way I've characterized it, we're a molecule company, not an electron company. And so we bring more value in the space required to manage and transform molecules, hydrogen and carbon molecules. Mm-hmm. That applies to CO2. And so what we're going to apply our capabilities to is the molecule side of the equation, which is carbon capture and storage, hydrogen, biofuels, capturing the emissions associated with existing hard to decarbonize industries that don't have any real practical alternatives and applying that. So we see huge opportunities there. In fact, our low carbon solutions business is turning those opportunities into high return projects today.
Yeah. But I know that Dan Ammon has talked about the fact that he won't do it unless he gets those high returns for low carbon solutions. Darren, would that include buying a refiner or buying more refining assets? Like if you got to move the stuff, if you got to move the molecules and make different things out of it, you need different refining capacity.
So when we look at our refining circuit, we're looking for what I'd say is a diversified set of capabilities and advantages. So if you look at what we've been doing in refinery, we've been concentrating our refinery footprint and focusing on the strategic refineries that are producing high-value products in the lubricant space, the chemical space, the fuel space, the traditional fuel space, but also the opportunity to use our technology to then bring in biofuels and biofeeds to make lower emissions fuels. So we feel really good about the footprint we have today. You can't just go out and buy that from a refinery. It really comes from years of integrated approach to investing and making sure you've got a refinery that is producing a portfolio of products that meet society needs.
Darren, none of this happens in a vacuum. You must be watching very carefully what is happening in the Middle East. I assume you are. To what extent do you think there is the possibility of a repeat of the 1970s, another oil shock coming? Or do you think the supply base is now diversified enough to avoid that? And I'm also hearing conversations regarding the possibility of a super cycle re-emerging. Do you see any eventuality that could lead to that at this point? How would you address these two issues?
Well, I would start with the latter, and again, the industry is still recovering from the impact of the pandemic and the lower levels of capital that have been going in across the industry to offset the depletion that's been happening. And so supplies are fairly tight. So the big issue is, where is demand at? If you see real growth in demand, then that's going to challenge the supply base that we have, which will put more pressure on prices and margins. Mm-hmm. So I think it's really a function of where does the global economies go in the years ahead, because for the next couple of years, it's going to take time to get additional capacity coming on. With respect to the Middle East,
No, go ahead. Finish.
With respect to the Middle East, what I'd say, it is still an important region in the world. And while to date, the tragic events are not manifesting themselves in an impact, that's something we're keeping a very close eye on.
Darren, do you see the global economy entering a recession, a soft landing? Do you see any of that on the horizon?
I think if you step back and look, the U.S. I think is in reasonably good shape. I think China continues a very slow emergence from some of the challenges it's had in the past. I think Europe is probably the most challenged region as I look around the world, and obviously they've been disadvantaged with the lack of energy security and some of the challenges they've had with the loss of affordable natural gas. And so I think that's going to continue to weigh on the European economies. Mm-hmm. And then I think feel relatively comfortable with what we're seeing in the other parts of the world, and we'll see. We build the business to handle any economic situation. Mm-hmm. We certainly go through these cycles, and so we make sure that we're robust to the down cycle.
Darren, you kind of led me perfectly there, because I wanted to ask about LNG, in particular Guyana. You have a new partner there, and at Chevron, you guys are not unlike working with each other. You guys do this all the time. Have you talked to Mike recently? What kind of development can you guys come together and really drive technology to get more stuff out of the ground there?
Well, I think if you look at what we've been doing in Guyana, we've got a really good track record there. We're the operator there. We run the projects. We're developing those projects. We've demonstrated over the last several years the ability to bring in these large, complicated projects at world-class schedules, world-class costs. We're beating our budgets. We're beating our schedules. And then once we get them online, we're running them at levels higher than what the investment basis was. So a very successful development process. We've got 3 boats, the third boat coming on here in November, and 3 more in the pipeline. So I think we've got a pretty good suite of technologies and capital projects that our organization is developing. We've worked with Hess in the past. Of course, we work with Chevron all around the world. I see them, their participation basically coming in and supporting the work that we've already demonstrated our ability to deliver on.
Darren, this is an industry that feels like it's back on the front foot, that you are optimistic, that you can see deals getting done. The industry is doing deals. We've seen 2 massive ones over the last few days, yours obviously included within that. A, do you think that's true? Which then takes me to a kind of bigger picture story. This industry has been pushed back hard over the last 10 years, let's call it, by the ESG movement. Do you think that ESG movement is now over?
I hope not. I don't think, ESG from our standpoint, this is not an either or proposition. This is an and equation where you've got to do both. You've got to develop the resources and the energy supplies that the world critically needs to support economic growth and support people's standards of living. And we've got to do things to reduce the emissions. We're working on both of those things. And so I don't see those competing against one another. In fact, to my point before, we're working on a set of solutions that are complementary and leverage the same skills and capacity. So we've always leaned into the need to produce low-cost, low-emissions energy sources and do that in our traditional businesses. We have continued to invest in that space, and we're continuing to work opportunities to grow value in that space. At the same time, we're leaning into the energy transition and using those capabilities to help not only reduce emissions in our own operations, but we're helping third parties, particularly hard to decarbonize industries, lower their emissions. We've got 3 large world-scale contracts with a fertilizer manufacturer, an industrial gas manufacturer, and a steel manufacturer to capture their emissions. Those 3 contracts in themselves is the equivalent of putting 2 million electric vehicles on the road. That's the number of electric vehicles that are currently on the road in the U.S. So think about that. 3 deals with carbon capture and storage equate to the same level of electric vehicles that are currently on the market.
Hey, Darren, we know you got to run. Thank you so much. We really appreciate you taking the time with us today. It was great to get through that. Next time, we're going to talk about 4-mile laterals and new technology. Darren was ExxonMobil chairman and CEO. So, Guy, what I also thought was interesting to your point, if you look at the ESG thing as like a wind and solar and the new alternative energies, that's very much a European energy play. Take a look at BP and Shell.
I think there's a bigger picture story here, which is that people have not invested in energy companies because of the ESG issue, despite the fact that energy companies are some of the biggest proponents and are executing on some of the biggest projects that are taking carbon out of the environment and are dealing with emissions, to Darren's point. Yet you couldn't own them because of the ESG mandates. And I wonder whether it's that bit that's going away now, that you can now, it's more of a level playing field. And it'll be interesting to see whether or not investors do approach it from that point of view.
Well, you have to wonder, too, if you had an ESG portfolio and you had things like Solar Edge and Enphase in it.
You're getting hurt.
Or Ørsted, for example, Vestas, like, you're feeling a lot of pain. And you don't want to look at your portfolio and have, like, negative 25%. I mean, that's really rough. I think it's also more sort of what does Shell and BP do, and any at this point? What do you have to buy? What do you have to sell? How do you refocus?
I think Shell and BP are in a difficult spot. If they move to New York, they trade on a completely different multiple.
BP, no way.
I know it'd be tough for either of them, but you do wonder whether there's an M&A opportunity there to get the multiples of those assets higher.
Yeah, BP has other problems, but maybe Shell, we can look at that. All right, we're about an hour into the U.S. trading session, a little bit mixed on this Friday. Bloomberg's Abigail Doolittle tracking those moves. Abby?
Yeah, Alex, not a real firm footing on this Friday, but on the week, it's pretty clear that we're looking at a decline. The NASDAQ 100 down 2.3%, the S&P 500 down for a second week in a row. Interestingly, though, beneath the lid, it's not all bad, especially for either of these big indexes. On the week, we have both Microsoft and Amazon trading higher on earnings reports that were seen as acceptable, both up more than 2%. Of course, Microsoft's cloud business in the here and now, or I should say in the here and was, the September quarter, 29% growth, and then Amazon talking it up for next year. On the other hand, though, we have Alphabet down on a disappointing cloud quarter, and then Meta, that color around next year and the possibility that the ad spend could be hit by the macro picture, those stocks down on the week. And of course, next week we have Apple and then Nvidia later in November for some of these big tech earnings. Relative to the macro picture, it's not an easy one. It's an interesting one, actually, because over the last month, take a look at the 10-year yield, up 26 basis points. You also have New York crude oil down 8.4%. It's hard to digest that. The VIX higher, and then, of course, Bitcoin, a haven, unclear, maybe it's the ETF, soaring. When we put this together for the S&P 500, this chart technically makes it very clear, I think, what's happening. This is a weekly chart, so it's a longer term. You can see the down last year, the up more recently, but now take a look at the breakdown that we've had out of the summer, Guy. The RSI on a weekly basis is going down. This chart makes the case for somewhere between 3,900 to 4,000 pretty easily.
Wow. Okay. That feels like a decent drop. We were talking about 5% being maybe acceptable. That feels like a little bit more. Abigail, great stuff. Thank you very much indeed. Abigail Doolittle. Coming up, we need to talk about what's happening with the car story. Ford is tumbling after pulling its profit forecast. CEO Jim Farley spoke about the negative impact of the strike. We're going to have more on this story next. This is Bloomberg.
for ETF Friday, and this actually dovetails really nicely with the conversation that Guy and I were just having about alternative energy. So clean energy ETFs getting completely battered despite underlying growth and fundamentals that you thought would have been really good. So clean energy ETFs led by solar, and that's an industry that's set now for 40% growth this year, but the recent volatility has remained a big hurdles for sentiment. So sure, you can have growth, but growth at what cost? Like, what's your return? What are your costs like, your input costs?
Growth and profitability are two different things.
Yeah.
And that we're learning really clearly with this industry. The solar industry has expanded really rapidly, and I think the solar industry is probably the furthest down the road on this, but you've seen some of the stocks getting dinged up so badly. But you look at what is happening with wind and some of the other technologies. Yeah. Oh my Lord, we've tried to run before we could walk.
Yeah.
This technology is clearly going to be huge down the road, but the engineering isn't quite there. The execution isn't quite there. We were talking to Darren Woods about this, and kind of just the oil companies are good at executing. Some of these other companies have yet to learn that skill, and it's really clear. And it's fascinating to see what's happening with these ETFs, therefore.
Also, if you have a lot of orders coming down the road, you ramp up capacity, right? But then what happens if orders stall a little bit? And now you have an oversupply. It's a cyclical industry that hasn't yet had like full cycles.
And you haven't learned the skills of writing contracts with what is the input prices clearly sort of delineated and understood.
Yeah, we were talking about that with Siemens Energy, that they don't know how to take commodity risk. Like, they took all the commodity risk. They're not hedging any of it. The contracts now will be written differently, but that doesn't help the here and now, for example.
Talking of that whole clean energy story, we should probably talk a little bit about what's happening with Ford. The shares are getting... the car crash is the wrong word, but these are really bad numbers. And a 10% drop over 2 days is, I find, perplexing, given the fact that we already understood that we're doing a deal with the UAW, and we now begin to understand the numbers. And of course, therefore, they're pulling their forecast because they're trying to get it all kind of lined up so they can actually present something that's realistic. Kevin Tynan, senior analyst for automobiles, joining us from Bloomberg Intelligence. Kevin, a 10% move over 2 days. I understand that we've got a deal done, but what is the market struggling with here?
Yeah, the market's really struggling with the Ford Model E unit, which is all the EVs from the earnings call, really not about, even the pulling of guidance for the rest of the year is more about, the uncertainty, but it's also not wanting to show big profitability while you're trying to sit down with the union and they're looking for pay increases and concessions. So this is really about the losses per vehicle and the outlook for the EV unit, which is supposed to be closer to profitability, if not at the gross line next year. Yeah. It's $37,000 per vehicle in terms of EBIT loss in the third quarter. And then you look at the other units, that Ford Pro is plus $5,700 per vehicle.
I mean, I just think it's really staggering. $37,000 per vehicle. That feels crazy. How on earth did they get to profit? Like, what miracle has to happen? Is it lowering costs? Is it efficiency? Is it massive demand? Like, how does that even happen?
Yeah, that's sort of the question, is to go from so wildly unprofitable, and granted it's early innings of the supposed transition that's imminent to electrification, but you wonder how you go from 37 underwater to the 10, 12 that you're making in internal combustion pickup trucks. And that's why the transition's been slow, especially in this country. It's not because they can't figure out the technology or they couldn't scale. They could if they wanted to. It would just be very unprofitable to do it. And you already have two other business units in Ford Blue and Ford Pro that are profitable, doing what they've always done. So the enticement to make the transition is just not there. And it may not be for a very long time.
Yeah, it's just crazy. Like, you have all the subsidies going into it. You have money to build the plants. I mean, like, what else is going to have to happen? Kevin, we appreciate it. Thanks a lot. Ford down almost, again, 9%. Kevin Tynan of Bloomberg Intelligence. All right, coming up, Sculptor sweetens the deal for Rhythm. And that got the support of founder Dan Auck. Details are coming up in today's Wall Street Beat.